Today, we're diving into one of the most influential investment books of all time, The Intelligent Investor by Benjamin Graham. Whether you're a seasoned investor or just someone curious about building wealth, this book is a treasure trove of timeless wisdom. By the end of this video, you'll have a clear understanding of Graham's key principles, practical strategies, and how you can apply them to make smarter financial decisions. Let's get started. First, let's talk about the author. Benjamin Graham is known as the father of value investing. He was a mentor to Warren Buffett, arguably the greatest investor of our time, who credits Graham's teachings as the foundation of his success. The Intelligent Investor, first published in 1949, has been hailed as the ultimate guide to investing. But what makes it so special? It's not just about stock picking or market trends. It's about cultivating the right mindset and principles to navigate the often unpredictable world of investing. The core message of The Intelligent Investor is simple yet profound. Successful investing isn't about beating the market. It's about controlling your emotions and adopting a disciplined, rational approach. Let's break down the key principles that make this book a game changer. One of Graham's most famous concepts is the distinction between the defensive and counterpricing investor. A defensive investor prioritizes safety and steady returns. Think of someone who wants to preserve their capital and avoid unnecessary risks. For this type of investor, Graham suggests a portfolio split between high-grade bonds and reliable, dividend-paying stocks. The goal here isn't to achieve extraordinary returns, but to safeguard against losses and ensure consistent growth. On the other hand, the enterprising investor is willing to put in more time and effort to research undervalued stocks and seize opportunities the market might overlook. But, and this is crucial, Graham emphasizes that this approach requires discipline, patience, and a deep understanding of what you're investing in. It's not about chasing trends or taking wild risks. It's about thorough analysis and sound judgment. Now, let's talk about one of the most iconic metaphors in investing, Graham's Mr. Market. Imagine the stock market as a business partner named Mr. Market every day. He offers to buy your shares or sell you his. Some days, he's wildly optimistic and quotes ridiculously high prices. Other days, he's overly pessimistic and offers bargain basement deals. Graham's advice: don't let Mr. Market's mood swings dictate your decisions. Instead, take advantage of his irrational behavior by buying undervalued stocks when he's pessimistic and avoiding overpriced ones when he's euphoric. This leads us to the concept of margin of safety, another cornerstone of Graham's philosophy. The idea here is to invest with a cushion, buying assets for less than their intrinsic value. Think of it as building a bridge that can support far more weight than expected. This margin protects you from errors in judgment, market downturns, or unforeseen events. It's about being conservative in your estimates and always prioritizing capital preservation. Let's make this relatable. Imagine you're buying a used car. You've researched its fair market value and concluded it's worth $10,000. If the seller offers it for $8,000, you have a margin of safety. Even if the car needs minor repairs, you're unlikely to overpay. The same principle applies to investing. Always aim to buy assets for less than what they're truly worth. Another important lesson from The Intelligent Investor is the danger of speculation versus investment. Speculation is when you gamble on short-term price movements, hoping to make a quick profit. Investment, on the other hand, is about thorough analysis and holding assets for their long-term value. Graham warns that confusing the two can be disastrous. He encourages readers to ask themselves, am I an investor or am I a speculator? Now, you might be wondering, how do I determine a stock's intrinsic value? Graham provides a framework for this, but the key takeaway is to focus on the fundamentals: earnings, assets, and growth potential, rather than market hype or recent trends. For example, if a company consistently generates strong profits and has a solid balance sheet, it's more likely to be a good investment than one with flashy marketing but weak financials. Let's pivot to actionable takeaways. First, know your investment profile. Are you defensive or enterprising? Be honest about your goals, time commitment, and risk tolerance. If you're defensive, consider low-cost index funds or ETFs that provide broad market exposure without requiring constant management. If you're enterprising, be prepared to dive into financial statements, industry reports, and valuation metrics. Second, cultivate emotional discipline. Investing is as much about temperament as it is about knowledge. When markets crash, resist the urge to panic sell. When markets soar, avoid the temptation to overpay for hyped-up stocks. Remember, your greatest enemy in investing is often yourself. Third, always insist on a margin of safety. Never invest without conducting thorough research and ensuring there's a cushion against potential losses. This principle applies not just to stocks, but to any financial decision, from real estate to starting a business. Finally, adopt a long-term perspective. Graham reminds us that the stock market is a voting machine in the short term, but a weighing machine in the long term. This means short-term fluctuations are often driven by emotions and speculation, but over time, true value prevails. Focus on building wealth steadily rather than chasing quick wins. As we wrap up, let's reflect on the essence of The Intelligent Investor. It's not just a book about making money, it's a guide to making thoughtful, rational decisions in the face of uncertainty. It teaches us that investing is a marathon, not a sprint, and that success comes from discipline, patience, and a commitment to timeless principles. If you're inspired by these ideas, I encourage you to pick up a copy of The Intelligent Investor and dive deeper. And remember, even the best strategies require consistent effort and self-awareness. Start small, stay disciplined, and watch your financial knowledge and confidence grow. Thank you for joining me on this journey through one of the greatest investment books of all time. If you found this video valuable, don't forget to like, share, and subscribe for more insights on books that can transform your life. Until next time, stay curious and keep learning.